Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a financial mediator and business valuation expert in St. Louis. Today's topic is actually talking about strategic planning, investment banking, exit planning, and really, we just use these terms a little interchangeable, but letting the numbers speak and why exit planning isn't the same as investment banking with Luntadila Paulo. And he is an immigrant from Angola. He's Pan-African, global citizen, and an entrepreneur. He founded Yeto Accounting and Tax PLLC in 2019 to help small business owners minimize their taxes and basically get ready to sell and increase their net worth. And I want to welcome you. Thank you so much for being our guest.
Thank you so much. Thank you, Melissa. It's a
And
pleasure
we're
to be here.
Yeah, and we're going to engage in a discussion because I think that what we're seeing in strategic planning, and you could call it exit planning, but what I'm seeing from a valuation perspective is owners are getting prepared to sell, but they may just think it's kind of like turning on a light. And so, okay, now I'm ready to sell. Let's go to market. And the reality is, some of the things that we're seeing in this space is that we can actually anchor the deal or provide kind of like a valuation floor for the negotiations. And in some capacity, and if we're still doing auction style process of selling businesses, if we start kind of putting forth our idea of the value, our idea of like the top 5 things about this company, right? Or
hmm
even exposing maybe some of the not great realities of the company. I think we're getting into a different type of negotiation. I think we're getting into a different type of deal strategy. And it's not this old school, like, come to the table and give me the highest price, because the highest price isn't
Yeah.
getting it done. It's like, it's
hmm
a bunch of things. So, kind of welcome. And maybe you could start us off with just your perspective of maybe how deals are changing. And then we'll get
Yep.
into this, who cares about investment banking or exit planning? But, there are
Yep.
some
Yep.
differences and it's a different perspective, right?
Yep. Yep. Absolutely. I agree with you. That's similar to what my team and I are seeing, right? A lot of business owners, they come to, or now I used to be an investment banker. They go to an investment banker or evaluation specialist like you and I, and they get their valuation. And I believe you're one of the top ones in the field, right? But some people essentially they give them, hey, here's your valuation, and you run with it, take it to a business broker or investment banker, and that's what you should expect somebody to offer you for acquiring your company. But you and I know that's not really what happens. And we also know good valuation should have given them not only their range of value, but also some of the things that are not good in the company that could be a bargaining place to reduce the value of the firm and therefore actually have a massive discount there, right? But very seldom that's actually happened. So what ends up happening is the business owner, right, is expecting to have their business sold, at essentially a mathematical formula, cash flow times industry average. That's what they think their business value looks like. But that cash flow number can be calculated in many different ways, and very proficient professionals will do a lot of adjustments because a lot of business owners are essentially a one man show or a one woman show, which means there are actually a lot of costs that they're taking on themselves that somebody else trying to replace them would need to pay for all these different hats that the business owner is wearing, right? So the valuation, that we're seeing out there, people bringing and telling us, hey, my previous, business analyst or, advisor gave me this, and this is what I'm expecting to have my company sold, right? it's a really tough place to begin conversations with business owners to let them know, hey, look, I understand you feel that way. You have invested a lot of money, a lot of your time, your personal life, including quality life with the people you love, but that's not necessarily what a serious buyer may be willing to purchase your company and paying, right? We really need to be a little bit more objective and let us try to do our work, right? As an independent outsider, right? So these are some of the conversations we're starting to have with business owners, and it's really tough. It's really tough because on one end, personally, I still feel like the exit planning, the valuation industry uh, are less regulated than, let's say, a CPA or CFA industry, right? And there are some actors out there who may not have the same level of quality of work that you do, right? They do a course and they think they're proficient and they run with that. They do a really good marketing and they attract people in the funnel, and that's kind of what makes me a little bit disappointed about what we're seeing in terms of quality of
Well,
service.
I
Yeah,
think that
go on.
you have the intersection of valuation, exit planning, and investment
Yep,
banking, and they're
yep,
three completely different things.
yep.
And from some context, you can get a valuation and you can take it to a business broker or an investment banker or an exit planner or whatever you want to
Hmm.
call them, and a consultant.
Yeah,
Let's call them a consultant. And
yeah,
you take it to the consultant,
yep.
and
Perfect.
they say, "Oh, that's a great value." And but that's not how we're going to like that's not at all how we're going to do it. And so
Yeah.
we've seen a lot of business brokers get into valuation credentials in order to do valuations in the process, but the reality
Hmm.
is these deals are being done on cash flow and a multiple of
Yep,
cash flow, and the
yep.
risk that the cash flow is going to continue in the perspective of the buyer, right? And
Hmm.
so if I
Yep.
perceive your business is risky,
Hmm.
I'm gonna kind of like, oh, I don't know. Like, what are some of the things that are being perceived as risky in
Hmm.
in your opinion when you're going to
Yep.
market?
Yeah. Let me break this down, in terms of, the size of the company. Okay. Generally, companies generating less than $1 million in earnings have certain characteristics that make them significantly riskier than, let's say, businesses between 1 to 3 million in earnings, where a lot of private equity are actually playing the lower middle market. And then you'll have, over $3 to $10 million in earnings. So, but let's begin with the below $1 million in earnings. These companies are often a one man or one woman show. And that's, the owner is, if not the single largest risk factor in these companies because they haven't managed to build two things: a management team and business systems around them. Let me add a little bit more detail here. In a management team, generally we expect to see a company being run by the CEO, the CFO, and the COO, right? The CFO manages the financial aspects of the company, the CEO, the operations. So let me go a little bit more detail there. So let's say we're talking about a steel erector business, right? We know the COO and the CFO are going to be working hands on, making sure the supply chain is there, the raw materials are there, the production capacity is there, and the fulfillment of the service, right? And in some of these businesses, we might need to see somebody, as the head of sales, right? Somebody who brings client, who manages clients' relationships, and so forth. But in many businesses, in around less than $1 million in earnings, we don't see many of these figures around the owner of the company. The owner of the company deals with business development, clients relationship. They typically have an outside bookkeeper who handles their bookkeeping and their tax preparation. And and the owner of the company is not necessarily expert in finance or in cash flow management or in bookkeeping or financial reporting. They do not know what they should be keeping track of in terms of their finances, so that eventually when somebody, arrives for due diligence, they're gonna be able to provide the type of granular details that is necessary to underwrite a deal, for example, right? And the owner is not doing that, right? On the system side, right? So I talked a little bit on the, your senior management side, but on the system side, we're not seeing number one, governance in the firm. Many of these companies don't have a board of advisors or a board of directors, right? They don't have their business strategy laid out, written. It's only in the head of the business owner himself. Nobody else in the company knows where the business is going, what the goals of the companies are, what's the value, what the mission, what are the objectives, how the company creates value and manages value and delivers value to all of its shareholders, right? They do not have written policies, manuals, procedures, how we do things, how we bring clients, how we onboard clients, how we onboard employees or offboard employees, how we manufacture XYZ, right? So a lot of these details are missing. And when somebody comes and shows up, let me tell you a story. Recently, I received an email from a lady in New Jersey, and she said, "Hey, listen, I received a number of offer in the last 3 months, and I'm trying to figure out what way to go about it." And I replied to her, "Why don't we meet and talk about what you want?" Right? She said, "Sure." And then we connected. The next day, we connected in a call. So we started talking about what you really wanted and not necessarily what these offers were. And she ended up realizing that she not only wasn't ready for exit, but the business itself was not ready for exit, because we have a list of just basic question we ask business owners, right? Do you have your last 12 months of your P&L? Do you have a balance sheet that reflects the accurate reality of your business, right? Do you have your tax returns filed in the last 3 years? Okay. Do you have contracts of all of your employees, current and former? Do you have any contract with any independent contractors, right? So as we started going down to that list, the more she became really concerned, because the offer might look great on paper, but if you're not able to meet the due diligence, you're not going anywhere. You're not exiting. And even when you meet the due diligence, once they can start, checking your company, bringing the really good advisors, right, to your company to look into things, right? Whatever they find, that offer might end up looking significantly different to the one that you received at first, right? The deal structure piece is gonna be drastically different, and that's typically where we see a lot of deals dying, because the seller was super excited with the initial offer they received, and they thought that's what I'm gonna walk away with, and then a 80% down payment end up becoming 30% or less down payment, earnouts, seller financing, okay, and a lot of clawbacks in the event what you told them the company will be making in the next 3 years doesn't materialize. right? So guess what? People get really sad and they just walk away from the deal table, right? So, you know,
Absolutely. I mean, I think that this is what's happening in transactions is even if you are a decent sized company and have 10 million of revenue, even up to 25 or 50 million, your books are
yeah,
not as clean as they should be. You're running personal expenses
yeah,
left and right. You're still in a tax minimization strategy as opposed to like profitability and showing profitability and or
mhm,
even segmenting your personal expenses into one account so that we can adequately adjust them. But this type of negotiation is happening between more unsophisticated buyers, and because they have
mhm,
money and they're entrepreneurs and they want to invest, but they don't know necessarily how to do deals. And you have sellers that obviously don't know how to do a deal, and so they're getting kind of caught up in the, oh, let's make an offer. And then they retrade it. Like I constantly talk about the retrade and positioning the deal better up front. And I think you've talked about some of the things that could help you get there. But timing is a very interesting factor in this because everybody thinks that you can just go to market and,
yeah,
I'll figure it out. And I'll tell you, when everybody starts to ask for those due diligence items and you don't have them ready or don't have answers to the questions, like it's a totally a tell that you're at the beginning of the deal, or you're not really serious about the deal, or you're using it as leverage. But talk to us about how these deals are being negotiated business owner to business owner. And some of the consultants, like, we're there, like I usually get a sign of like my guys, like, okay, you answer these questions. I have no idea what they're asking. But
yeah,
sometimes we're including the business owners in some of the negotiations, not some of the beginning ones.
mhm,
But a lot of our sellers are surprised by the conversations that we have, and they're
yeah,
they're talking about their company as if it is a commodity, and it's talking
mhm,
about their people as if they are commodities, and it's not a feel good process. So how do you get
yeah,
prepared for having thick skin in this process of somebody coming in and really looking at your baby and saying, oh, I don't think you get that much income, oh, you weren't
yeah,
that profitable.
yeah. Absolutely. You know, this is part of the reason it's so critical to prepare for an exit, to prepare for it doesn't matter if you don't want to sell the company, you still need to prepare for your eventual exit, whether you're going to end up winding down the company or you're going to end up transferring the company internally to the people you love and care about, right? Because a big problem that I often see is people thinking, "Hey, because people are showing interest in my company, I therefore have a great asset." No, it might not be entirely correct. That's actually, in my experience, a losing proposition because just think about the art of the war, right? Whoever determines where the battle will be fought and when the battle will be fought is typically the general who wins, right? So, what am I trying to say here, right? A business owner who receives an offer, who wasn't preparing to sell their company, who wasn't thinking about selling their company, and somebody shows up, guess what? They're at a big disadvantage because somebody else is telling them what the business should be valued at, is making an offer, is telling them when they should be exiting and at what price they should be exiting, right? Even though, there is an interesting, psychological bias that I admire a lot, right? The anchoring bias, right? Once you have that initial value in mind, hey, she said or he said X amount of money, therefore it's really that or just a little bit below or a little bit above, right? So that anchoring element, that's a big problem to a lot of business owners, right? So, and when we advisor begin a relationship with a business owner, the first part that we try to prepare, or at least on my end, is not necessarily me, because I know how I'm going to proceed with the negotiation and the deal, the engagement. I know how to research the other side of the conversation, some form of, mutual due diligence there, it's going to happen. But the big problem is the business owner themselves. Sometimes we have to begin with the education piece. And that's not, I shouldn't even say sometime, it's very often the beginning element, right? In my firm, the first thing we do, right, we do a crash course of the exit process, right? If you engage us to help you uh, negotiate a deal and you want to sell, we begin with that crash course. What you should expect the process to look like, the timeline, the key milestone, the biggest parts where we're going to have issues, and how we expect to navigate around there, and especially to understand what are your goals and your objectives, right? And the starting point is to understand, okay, how far are you willing to go with the negotiation in terms of time, in terms of value? Are you expecting to get certain amount of money with your exit, with the business sale? If so, how much? And we're gonna tell you whether or not it's realistic. If your business have a number, let's just say five of the problem we discussed here a little bit, uh, and you're expecting, let's say, you're generating 500,000 in earnings, and you're expecting to get, let's say, 4 times multiple, that might not be realistic. And we'll tell you that. And look, if you really want to exit in the next 12 months, we don't think that that could happen. We can still go in the market advising you, but that may not actually happen because of that these problems you have here. And unless you address this problem and maybe wait a little bit more, then you can actually get better results. Otherwise, here's what we think could be a good spot for you in terms of value for your business, right? So, and when we begin the conversation with the other side, right, we're really careful to understand some elements, especially on our own side, right? Conflict of interest, because some engagements we are, when the client approach us, we are thinking of them in terms of retainer plus success fee. And sometimes, tying up the success fee to the price of the exit could be a little bit tempting, could be a little bit, challenging, because we've seen this actually happening with other advisors, where they want to sell the company to the highest possible price to the seller, even though we knew that company would never sell at that price. And the owner wanted to exit as soon as possible, and they were willing to compromise. The business broker was just not interested in bringing those offers to them. That's not good. That's not acceptable. Okay, so we really need to make sure we look internally. What are the risks on our end? What are the ethical concerns we need to address? What are the conflict of interest we need to get cleaned right up front, so that when we start the negotiation on the other side, you're not going to believe this. We've received an offer from a competitive auction where the other side tried to bribe our firm, to pass their deal so that we can get paid on the seller side and their side. I was just like, did these guys just lose their mind? Like,
Well, but
no.
we're seeing a lot of business brokers that are working in the middle. I mean, there is a whole group of professionals that are working in the middle. The
Yeah.
reality is, if you, like, and tell me if you disagree, but the reality is, right now, for small businesses, I mean, you're going to get 3 to 5 times your cash flow. You're going to get the next 3 to 5 years of cash flow now, if you can prove that you can really sustain that cash flow. And
Yeah.
for the most part, they can't always, like, there's volatility in the cash flow, or there's inconsistencies in the cash flow, or the cash flow was based on these relationships that may not be as transferable. So I think that
Hmm.
a lot of times it's kind of understanding, is your cash flow, like, they give you an offer for $5 million based on a certain cash flow, and then they look at your cash
Hmm.
flow and they're like, you're not achieving that. If anything, the
Yeah.
consultants need to be giving the business owner a reality check that this business is going to be sold on your cash flow, and then how many warts or problems come with that cash flow. And so the more you eliminate some of those, you're going to get
Hmm.
to a different situation, or you're upfront with them, right? Because I don't think that some of them you might not be able to eliminate, but you can be upfront with it and you can say, hey, here's these issues. We're still selling at a price. We're still negotiating this deal at some sort of extreme price. But like, are the days of getting this premium pricing, this 10 times EBITDA, 20 times EBITDA, 4 times revenue, it's just not happening in the lower middle market, in my opinion, unless you have some sort of patent, some sort of crazy idea, you're a unicorn or something, like, you're really just getting some of the future income faster. And if you
Yeah.
want it to be, and then you have to pay taxes. And they're like, wait, what? Like, I know you deal with this more often, but people are just saying, oh, here's the deal you're going to get. And then it's like, wah, wah, you have to pay taxes,
Mm.
and it lowers
Yeah.
the deal completely. So how are you dealing with, I know you said educating them on even deal structure. Like, are you having to educate them on stock and asset sales? Are you still seeing a prevalence, or what are you seeing the market moving towards?
Um, Great question again. That education piece is really critical, and we try not to be everything for the client, right? We want to make sure that the client, throughout that mini crash course we put together, we tell the client number, also, okay, you need to start thinking about these other consultant or professionals to bring if you really want to have a good exit. So if a client hires us to only do their initial valuation, that's all we're gonna do. But we're gonna let them know, hey, down the road you'll need X, Y, Z. If they hire us to be their exit planning specialist, we're gonna be with them throughout the entire process until they exit, right? But we're gonna need an attorney. If they didn't hire us to do their tax planning for the exit, we're not gonna touch them. We'll tell them you need to have a tax specialist in this engagement, right? If they are in a really niche industry, let's say with crazy engineering, we might need to bring some other consultant that really specialize in that specific key area of their business, right? To make sure the company is very well positioned. But just let me go back to your question around the structure, right? The conversation around, how your deal will be structured is really important because it depends on the type of entity you run, right? If you are a single member LLC, multi-member LLC, an S corp, a C corp, right? Uh, all this is very important. What are you trying to sell? The equity of the company, or are you trying to sell the stock? Oh, excuse me, the assets of the company, right? Is there room for section 334 or not? Like, what are we trying to accomplish here? Because we let the business owner very clear, hey, whichever direction we're gonna try to go, he's gonna have different tax consequence for you, but also the other side coming to the party is gonna have their own perception of value and different offer that they'll be trying to make. So But here's what you need to know. But at the end of the day, we really stay on our own lane. If the client didn't hire us to do other thing for them, we're not gonna provide any advice there because our engagement letter are very clear and to the point. If you want us to do something else, then we need to either amend or sign another engagement letter. But the education piece is going to include, from A to Z, what a transaction looks like and what you should expect and who else you need to bring as part of your team. Some clients want to go cheap, and this is actually a big problem that I see. They want to use the same attorney that handles their property acquisitions. I'm just like, um, I tell them this is gonna be a catastrophe. Don't do it. Don't do it. Right? Or you
Well, and
know,
those are some instances where exit
yeah,
planning is different than investment banking. Investment banking, you're coming in, you're just going to auction, you're selling it to the
yeah,
highest bidder. Hopefully
yeah.
the culture works, hopefully they care about your people, but who cares, right? Get the highest dollar. We know
Yeah.
that most people don't care about, I mean, they care about the highest dollar until it comes to picking the highest dollar and they're like, oh, but I like these people better. I think that they're going to take care of my employees better. Like I feel like this legacy is going to continue. And
Hmm.
then it starts to become important to them. And exit planning, if you tell us a little bit more about it, and everybody is encouraging business owners to really look at exit planning as a process. And I'm even saying be ready each year. Do a valuation metric each year so that you know if you're trending towards a
Hmm.
sale or you want to pull the trigger immediately. But for the most part, people are getting approached by buyers because they're like, wow, you don't have debt. You're doing a great business. Everybody knows your name in the industry. You're a thought leader. You're creating new ways of doing things. Like they're coming to
Hmm.
these businesses and they're like, we want to buy you. And they're like, okay, hold on. Let me call you back in a couple of weeks or a month or 5 months. And then, that deal isn't necessarily going to be as available at that point.
Yeah, yeah. And thanks again for starting to highlight, some of the biggest gaps and differences between the work I used to do as an investment banker and what I do today as an exit planner, right? Because part of the reason I transitioned out of investment banking has been exactly because of what I've seen happening as an investment banker, right? We would get deals. I would be assigned to deals, working with managing directors, and I knew, I didn't even need to spend a week looking into a company to know that this is not gonna get sold. This is just not going anywhere, right? And some business owners didn't know that. And from this conversation, as you well put it, an investment banker or business broker receives a deal, the company, you want to get it sold? Sure. Okay. Here's what we're going to do for you. We're going to put together an investment memorandum or confidential information memorandum. We're going to put together a teaser, an NDA, and we're going to put together a list of potential buyer. We're going to send to them a teaser. If they like it, we'll send to them an NDA. Once they sign it, they'll get the initial information memorandum. If they have any question, they'll set up meetings with us initially, and then we'll keep the ball rolling, right? Until we get an offer, something like that. But here's the truth. The vast majority, I would say probably 99.9% of companies that we got on the pipeline never got anywhere, right? Because here's what really happens. We get the deals first to the people in our circle that we have very good relationship with them and to see if they have an appetite for that. And pretty much maybe 99.999% of them will say pass. Once we see that, we bring it to the next level of our contact, right? We send it to maybe another 100 contacts to see the appetite in the market, just to test the waters, right? So that we can have a sample. And once we have passed from all of these, then we put it to the market for just anybody out there, right? Who's going to be excited enough to look into any opportunity, right? And sometimes, we could have sent a teaser to 10,000 people, and maybe 10 of these 10,000 people will be interested in the company because the fundamental are not right. And I kept thinking, oh my God, this is really bad, because the seller is wasting time thinking that the business is in the market, somebody's gonna buy it, is gonna approach you to acquire it, when the investment banker really knows this is not gonna happen. But they're, sadly, some of them are just not, you know, I don't want to say they're not honest. Maybe they just don't have the courage enough to face their clients head on and tell them, hey, look, this is not going to go anywhere. You need to go back to the basic and fix this and that, right? And in 1 to 2 years, come back so that we can get this back to the market once you address this. And in a very few cases, this has actually happened. Okay. And now, once I transition out of investment banking to exit planning, the conversation is much different. The conversation became, hey, what are your goals and how can we achieve those goals? Is your business in its current state capable of delivering you the results you're looking to achieve? If not, what should happen between now and then to get you where you want to go, right? An investment banker is working with you maybe a few months to a year. Some businesses today stay longer in the market, and those are typically the bad. I don't want to say the bad, but the not prepared one. Okay, but an exit planner, I ran the math around how long actually it takes for you to exit well. On average, you need about 3 to 5 years to prepare your company, especially if it was in a really bad position, in a bad shape, right? So that conversation you brought up, right? Shifting from tax minimization to profit maximization, right? So that you need to show a track record of at least 3 years. 5 years is perfect. It's ideal, right? You need 3 to 5 years to actually, you know, get your company to look nice, to improve it, to fix the problem, the red flags, and then 1 to 2 years in the market for sale. And even so, a buyer will still ask you to stay around a little bit. So maybe another 1 to 3 years to transition the firm. So essentially, we're looking at least for about 10 years timeline where if you want to get a great exit, you really need to think about that. And guess what's funny? When we reach out to business owner, because we have a really strong um, business development team, to tell them, hey, look, I know you are a business owner because we did some research. You need to start preparing for your exit today, whether or not it includes selling your company. They tell me, I still have time.
Well, and even from a marketing perspective, we're telling them to build businesses with the exit in mind, like name it and create the pipeline and the
Yeah,
online, the URLs, the handles on social media so that you lock down that concept. But you have a
yeah,
very interesting conversation that you're getting into. And as a valuator, that's where we're getting involved with investment bankers, with exit planners, is having that uncomfortable conversation. And I think everybody out there who is doing valuation should be using the valuation as the way to consult with them and make them understand how these things are going to move the value, because then you're kind of
Yeah.
not telling them that their baby is ugly, but you have to have those uncomfortable conversations because they literally don't have a clue that some of the things
Hmm.
that they are really proud of could
Yeah.
actually result in a lower value, because not everybody's going to see that as a red flag instead of what they think is really amazing. And I
Yeah.
think that the more you can disclose and have that conversation with them, use the
Hmm.
valuation as a metric and say,
Yeah.
okay, well, how do we increase value? Cash
Yeah.
flow, increase in
Hmm.
assets, increase in revenue, lower cost. I mean, get additional better paying clients, get contracts with your clients, like
Yep.
I I think that everybody around them has said how successful they are, and they've believed that and they've made a lot of money. But when they come to here, is some of us are saying, well, I mean, I know you did well, but we got to clean up a whole bunch of stuff. And sometimes that is an uncomfortable conversation that a business owner is
Hmm.
not interested in. Right. And
Yeah.
it could even
Yeah.
feel like we're pointing at their current people that they're surrounding themselves with. But it's just that everybody has to do better and up the game in order to get sold at a good price. Right.
Yeah. Absolutely. Absolutely. And thanks for bringing that up, because you know I'm a business owner. You're a business owner, and it makes it slightly easier to begin the conversation, because I think, oh my gosh, if somebody would show up and tell me, hey, I'm not doing a good job with my company, I wouldn't be happy with that either. Uh, Yet, I still need to realize that if I'm not building this company from the perspective of a potential buyer, I'm not doing myself a good job, right? As long as I remain stubborn to think I'm doing the best that I can, my best may not be the best of somebody else, of somebody else. And because of that, it's a challenge to shift the positioning from I'm building this company for me to I'm building this company for an exit, whatever that exit could look like, right? And sometimes, and you know, when we do exit planning for business owner, we try to show them, other options. Maybe we can do a majority recap here. Maybe we can do a refinancing in your company, right? Maybe you don't have to sell everything, right? You can do a minority, you can do a majority. We just need to understand where you're going and give you options of how you can get there, right? But it doesn't matter what are our options to getting there. You need to fix the fundamentals.
Well,
You need to
and
get the. Hmm.
you need to understand that the all cash upfront deal is the unicorn. And that I know that everybody wants to think that that's how, like, of course I want an all cash upfront deal, but you said a couple things earlier that I'm hearing from buyers left and right. Oh, will the owner finance some of this? Like, can we pay in installments? Can we, buy a portion now and a portion later? What if we can't get bank financing? Will you hold something back? And like with the SBA, if you get SBA financing, they're not going to let you get paid back on your portion until after the SBA is paid back. So, and
Yep.
those are different deals. Again, everybody loves the huge deals that are 5-10 million in EBITDA and they have these big buyers. Again, these all cash deals, I know they were what we always experienced, but for smaller companies, like let's say you're a
Hmm.
plumber, let's say you're HVAC or, electrical contractor or something in that space. Are you really
Hmm.
going out and getting sold to some huge company or private equity? Or are you doing a deal with another guy that's twice your
Hmm.
size or another lady that's a, minority owned business, a women owned business? Like we're seeing a lot of deals in that space and there are limited buyers in that space, right? So,
Yeah.
how do we fix some of this? Or maybe you should talk about some of your solutions in your company too, right? I mean, because you
Yeah,
can't,
yeah.
if somebody's telling you that they can go get you an all cash deal and you have under $1 million in EBITDA, I would just say, prove it, because that is, and they're not going to charge you an arm and a leg, right? Because that takes a
Mhm.
lot of work. So I think that you have to make your company be more sellable so that the
Yeah.
person doesn't have to work as much, is kind of what we're trying to get at in this process. Don't you think?
Yep, absolutely. So, number one thing we try to get business owners to absolutely do, right? Remove them from the picture. Number one, it doesn't matter what are the biggest problems yet, right? We want the owner out of the picture because we know that's a very big value uh, diluting element in the company. As long as the owner is still the face of the company and knows how to do everything there, we have a big problem. So our plan often includes removing the owner from the picture. That's our starting point, and we start mapping out what the owners know that other people should start learning and knowing about the company. What responsibility they have that needs to begin going to other people, what we should start delegating, what position we need to start filling, replacing, because it's better to have a $500,000 in earnings with a strong management team that doesn't rely on the owner than to have a $700 earnings business where the owner does everything.
Mm-hmm.
It's much, 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 much better that the owner is not there. So that's number one. Number two, right? We really love to drill down into the revenue streams of the company, right? We do a lot of analytics there, right? Where it's coming from, what services are bringing the revenue, and oftentimes we realize, that a good part of the revenue is actually just coming from a handful of the services or offers that the company provide, and some offers are value losing elements. And we might have a conversation around shifting resources either to eliminate whatever it's losing money to the firm or allocating some more cash flow there to, excuse me, to increase the company's revenue in that space. We look into contract. We look into the trends in the revenue on a monthly basis, on a quarterly basis, cyclicality. We look the concentration of the revenue, the risk exposure around different revenue streams, right? If there is any client, any supply chain issue that can rise there that would impair that revenue. We're doing a lot of analytics there to make sure the revenue is solid, is recurring, but unfortunately some industry are not as recurring as we would love to see, like construction or remodeling or you know oil and gas. So what we do there is to build a solid sales and development business development team that actually is competent and capable of winning new contracts, new clients with a high degree of predictability, because that's what we're really trying to sell, right? High degree of predictability that, even if the owner is not here, there are people in the company, there are systems in the company that allows the company continue generating new business. Okay. We're looking there. We're
Well,
also
and
looking. Yep.
another area that I think that, people are starting to look at is trailing 12 months. Like everything is what have you done for me lately? What have you done for the 12 months? And for the most
Yep.
part, business owners are kind of like, hey, it's the year end. What's my taxes look like? And no, this is like you need to be at a minimum looking at it every quarter. But I'm saying,
Yep.
really, on a monthly basis, meeting with your professionals and getting on top of that so that you're like, wait, what? This expense is out of control. Wait, this vendor didn't pay because you also need to clean up your accounts receivable, because if they find out you're
Hmm.
selling, they might not want to pay you. So all of this is getting a better handle on your numbers, because if you
Yep.
are the business owner and you're negotiating and you don't know your
Yep.
numbers, so I think all
Yep.
of these are amazing ideas.
Yeah, I agree. I agree. Right. So, what you described, and we go to a very extensive process, right? Addressing all these elements: financials, operations, commercial side, the strategy of the company, to make sure, from the legal standpoint, regulatory, risks, to make sure that the business is actually addressing what needs to be addressed, what needs to be worked on, so that we can get to the outcomes we want to get. That's typically, the process, the work we would do for our clients. And here's another fantastic story. A business owner. She's a lady here in Chicago. I won't say the industry, but they're up north. That takes care of. Okay, if I say what they takes care of, it might give, because they're one of the big one in the north side. But they have a business that does approximately $2 million in revenue. Would you guess what's their profit?
Well, I would hope that they were making maybe 250,000 at the bottom line.
Yeah, at least. But when you look at their tax returns, they make less than $50,000 a year. Yeah,
Yeah.
and here's the most painful part, at least for me, was to learn from her that she has less than 100K in retirement.
Mhm.
Okay, and she expect to exit her company in the next 3 years. Okay,
Yes.
and her situation is not unique.
No,
This is
and
the
we had a very similar situation, and they tried to do a deal, and the SBA was just like, you have $50,000 of income coming into this business. We can't go and sell this for $2 million. We can't go and sell this for $1 million even. Like, we're
yeah,
not going to fund it. So, this is happening all the time because they take really aggressive strategies to either put their personal expenses in the company that reduces its taxable income. And
yeah,
we have to reverse it. You have to start paying taxes and you have to start reporting more income and getting it to the point where maybe you have tax strategies. But I think this is happening all the time, like more
yeah,
often than not. Right?
yeah. Unfortunately, so the work you do, the work your team does, my firm and other professionals, it's really critical for business owner to really start taking a little bit more serious their
Mhm.
future, their family's future. Like I am obsessed with making sure that the people around me are very well cared of and protected. I have a life insurance, I have disabilities insurance, income replacement insurance, because my firm is still at a very early stage and I am the head of my household. right? If anything happens to me, I want to make sure that my family is not, they may be in pain for losing me, but they're not going to be in financial pain. For a lot of business owners, that's not the reality. They're not thinking about tomorrow. They think what happened to somebody else will never happen to me. And I really hope never do happen to you. But life is just so unpredictable, and it's important to plan for the worst tomorrow, even though we're hoping for the best, right? And I always encourage business owners, say, you really need to plan about your exit. It doesn't matter if you plan to sell. You need to begin building your firm from the perspective of somebody else, right? Not your own perspective. Unless you want to build a lifestyle business, sure, no problem. But at least build it in a way that will provide security for the people you love, right? If anything ever happens to you, they'll be taken care of, they'll be protected, they'll have something to worry less about, right? That is, their bank account will be funded, the kids will go to college, your spouse will not be in a bad position financially and have to start from literally zero because the breadwinner is no longer there, right? So,
Well, and
um,
and I think that this has been really a different type of conversation that we're having about selling your company. And, part of it is I started in investment banking 20 years ago. You've been in investment banking. We both know what the valuation world looks like, the CPA world looks like, the accounting advisory world, and deals are getting done different. And I
yeah.
think that you have really provided kind of a unique way of looking at it. And I know that if people reach out to you, they can meet with you and talk through some of your services. And even going forward on the valuation podcast, we're looking for more people who are wanting to talk about different ways of doing business and, more holistic ways of helping business owners get to the next space. Because what we know about business owners is like this might, yes, they might be retiring, but this might just be moving into a different advisory role as well. And so you can guide them in that
Yeah.
capacity and get them ready for the
Hmm.
scariness of not being in control of a business. But these deals are being done different, and valuators and CPAs and people that have some business acumen can really help the business owners. But, you need to be mindful of what's happening out there, and you need to be mindful of how you could run across a buyer that's going to try to take advantage, and preventing that, and this. So I think preventing it in a way that you are just an amazing company and you can always walk away from a deal, in my mind,
Yeah.
is the biggest power in negotiating. And so do you have any final tip that you have for any business owners or advisors out there in this space?
Oh yeah, absolutely. My final tip is, if you want to begin the journey, prepare. The only thing you really need to do is to begin early, to give yourself time to prepare yourself, your company for an exit, because it's a process. It's not a one event, one thing happening. That's not what an exit looks like. It's gonna be very long, it's very demanding, and you really need to make sure you're working with people who have, your best interests in their hearts, right? People who are gonna be there for you, are gonna walk with you the journey and make sure that your interest is protected, is preserved, and can actually help you get the results you want, right? Because if you don't start early, you don't start building a team around you, right? Somebody like Melissa to do your valuation, to help you with what you trying to understand on a yearly basis. It's gonna be really rough for you when somebody shows up and say, "I wanna buy your company." You may not actually have a company to be sold, right? It's very important to always ask yourself, what are you trying to sell? Yourself or the company, right?
Yeah,
And a lot of people,
and a lot of this is legacy. If it's
yeah,
important to you to have a legacy, if it's important for you to have some of this company continue, and
yeah,
sometimes people say it's not important until the end, and it really is
mm,
important, then
yeah,
there's a different way of going about it. And like it has to be more thought than what you put in to sell your house, and
yeah,
sell your other assets. Like this is a big, big situation. And maybe you get to go be another type of business owner. So like it's not just setting
yeah,
into the sunset and drinking Mai
yeah,
Tais on the beach. It's like you can go and invest your money in other efforts that I think
yeah,
could be just as rewarding and take less of your actual time. So we really
absolutely.
appreciate all of your advice and information, and reach out if you have any questions. And if you have another concept to talk about, please come back, because you've been a joy to interview, and I
Thank
appreciate
you.
your perspective.
Thank you so much. I appreciate having me. Thank you so much.
Talk to you soon.
Thank you so